Meet Emily. Emily has been renting an apartment with her wife Olivia for the past 7 years. Recently, Olivia has made it clear to Emily that she wants to move to the suburbs where there are better schools for their twin girls. Emily agrees with Olivia and has just watched our video, Buy or Rent a Home, and now understands that buying a home is the right choice for her. There's just one problem. Emily can't afford to buy a house on her own. What should she do? Well, luckily for Emily, there exists a ready-made solution to this problem: mortgages. Mortgages are just like loans, and like most loans, they offer Emily a fixed amount of money at a certain interest rate for a set period of time. However, unlike most loans, mortgages come in 3 distinct flavors: fixed rate, which have fixed interest rates; ARM, which have adjustable interest rates; and hybrid ARM, which have fixed rates in the beginning of the loan and then adjustable rates by the end. Mortgages are also unique in the fact that they're always collateralized by a house, which the bank can take if Emily doesn't repay her loan. Finally, mortgages also come with 3 rather unique expenses. The first is closing costs, a group of fees charged by the lender when creating the loan. These fees generally range between 2 to 5% of the home's purchase price, but can be even more if you choose to lower your loan's interest rate by buying what are called discount points, each of which are worth 1% of the loan balance. The second expense is property tax, which is a tax based on a percentage of your home's market value. For example, if your local property taxes are 3% and your home is worth about $100,000, you'd pay $3,000 in property tax. The last expense is insurance, and it comes in 2 forms. The first is homeowner's insurance. This insurance is required to get a mortgage and will protect Emily in the event that her home is damaged or someone is injured on her property. For more details on this, be sure to check out our video, Homeowners Insurance 101. The second form of insurance is private mortgage insurance, or PMI. This is a monthly fee lenders charge to offset the risk of a borrower not repaying the loan. While that can get expensive, PMI is not a universal requirement, as only those with less than a 20% down payment are forced to get it. But wait, hold up. What's even a down payment? Well, generally when purchasing a home, lenders will require people to use a combination of both their own money, called a down payment, and debt. For example, if Emily wanted to buy a house worth $100,000 and was asked to put 20% down, she'd pay $20,000 and the lender would cover the rest. While this does sound expensive, a 20% down payment remains the gold standard in the industry for 3 very good reasons. 1, you're far more likely to be approved for a mortgage. 2, you can avoid the monthly PMI fee. And 3, lenders will offer you a lower interest rate. However, if Emily can't afford a large down payment, she can still apply for an FHA loan. These are loans issued by private lenders but insured by the government, which translates into a much lower credit score and down payment requirement, as little as 3.5%. Hopefully you and Emily now have a better understanding of how mortgages work. Be sure to check out our next video, where you can learn how to actually get a house and a mortgage, and be sure to check out our website, where you can find great real estate agents, mortgages, and more educational content.